Hello, everyone, and welcome to another episode of Majlis and Markets. As always, I am your host, Hassan Jivraj. Really happy to be doing another episode. I think we're at episode 68, I want to say. I'll double check that afterwards and register that, but I think it is episode 68 overall. And I'm really happy to be back on YouTube doing a video vodcast and podcast as well. And please, before we begin this episode, do remember to like, share, and subscribe, and also sign up to all our social media platforms as well. But I'd like to introduce today's guest for this episode, none other than Diego Lopez, back for part two. Diego, welcome back.
Thank you very much, Hassan. And I must say, 68 episodes, you guys are doing an excellent job.
Yeah,
Congrats. I've seen a lot of episodes with high caliber speakers, so kudos for that.
thank you so much, Diego. You know, you're probably one of I think you're number 3 out of the 68 or the 67 that we've done so far. You're number 4 out of the most listened. And I was just saying to you just now, as we started recording, we did that back in April 2024, which feels like a lifetime ago. You know, it was a long, long time ago. Well, it wasn't that long ago, but like in the world of economics and finance and politics, it's like changed a lot. And yeah, it's like one of the most listened to episodes. And I always get messages from people saying they really enjoyed this episode. So it's really great to have you back for part 2. Diego, you know, tell us what you've been up to since the last podcast.
Yeah, absolutely, Hassan. I mean, I'm here in Singapore, as you can see. I think 15 months ago, I was just getting settled. So the firm is now quite rooted in Singapore. It's actually our biggest office. We've been focusing a lot on Asia, both in terms of hiring more people and getting more client base in this part of the world. And actually, a few months ago, we also completed our first hire in the UAE. So we now have people in New York, London, Abu Dhabi, and Singapore, which is great in a short span of 5 years. And then on the product side, we've been very busy launching our own AI tool, which we just launched a few weeks ago. So it's going to sort of change the way that our subscribers, so the main market players, consume our data and research. So very exciting all around. I'm very happy to be here to tell you all about it.
Amazing, amazing. Diego, it's like you've done like really amazing work. And you know, we had in our first episode with you, we had a nice overview of what sovereign wealth funds are, the role of sovereign wealth funds in economies, the role of sovereign wealth funds in Gulf economies particularly, and indeed across oil exporting or commodity exporting countries. But Diego, you know, we're in a different world now with the election of Donald Trump last year in November, his policies since the beginning of this year, most notably with the tariffs and other domestic economic policies. How would you characterize 2025? We're recording this in July 2025. How would you record the first half of this year with regards to sovereign wealth funds?
Yeah, I mean, generally, it's a very upsetting war, I would say, right? You wake up here in Asia, you switch on the TV or the YouTube, and you watch what has been going on in the past day or two in the US and in the rest of the world. And it's quite sad, also in terms of the wars and everything from inequality to general distress. It's a very upsetting war, really. But at the end of the day, you have to find, good things that bring you joy and keep adding value. So, I mean, we are very fortunate to be covering the world of sovereign wealth funds. I think it's a fascinating world that mixes politics and economics and finance. And every day is a new adventure covering them. We always get news from either the Middle East or here in Asia or back in Europe or in Canada or in Australia. So it's a very fascinating world where you cannot really sleep on anything because everything changes very rapidly, as we said before.
And just leading on from that, Diego, what have been the biggest or what are the biggest trends so far this year for sovereign wealth funds on a global stage?
Yeah, I mean, to me, the most striking thing is the overall disconnect between what they call Main Street and Wall Street, right? So, you see all this bad news, of course, and uncertainty in the economy globally. And then you see that financial markets keep performing well. So it's quite striking, it's quite surprising. And that has an effect in sovereign wealth funds, right? So sovereign wealth funds, on average, they have about 60% in public markets. So that means that whenever financial markets are up, sovereign wealth funds are up. So the AUM has been growing non-stop, and it's about to take 14 trillion US dollars. So 14 trillion US dollars for the first time in history. It's really unparalleled what we have been experiencing. Obviously, I think oil prices being in the 70s also helps. So they keep, especially the ones in the Gulf, they keep receiving inflows that they need to put to work. So again, really historical momentum that we're living in sovereign wealth funds with new vehicles arising everywhere in every corner of the world. So very fascinating world to cover for sure.
Before we cover the Gulf and what's happening over there, how would you say sovereign wealth funds are acting differently? You can talk about things like semiconductors, AI, renewables. What's been like the difference compared from, say, last year in the way sovereign wealth funds have been investing and behaving, I would say?
Yeah, absolutely. I think in general, they are behaving more cautiously in the sense that their deployment of capital has been decreasing a little bit when compared to previous years, especially when it comes to volume. And the reason is that in 2021, 2022, if you remember, true capital was very hot. And therefore, sovereign funds and pension funds were investing a lot in startups. And these tickets are normally lower, right? So that means that the volume was much higher. Today, I mean, in the first 6 months of the year, we saw about $100 billion invested by sovereign investors, including pension funds, in about 225 deals. So the volume has decreased significantly, but the value has stayed fairly constant. And that means that the average size of the ticket has increased quite a bit. The reason is that they are focusing more on things like private credit, private equity, infrastructure, and those are in general larger transactions. So they are still putting capital to work, but they do so in larger transactions. And therefore, it's fewer deals that we're seeing. But things like you said, AI, sustainable finance, even space investing, and then partnership in the sense of private credit, they are all staying quite hot. And I think in general, parents are still trying to allocate more and more capital into private markets as opposed to public markets. So moving away from the 60-40 classic model into more contemporaneous themes, if you will. So I think this is what we're seeing in the past 6 months or in the past few years, actually. But it's also what we expect to see in the next few months and years.
With the arrival of Donald Trump 2.0 this year, how do you think geopolitical tensions, obviously with the US and China and other players as well, how are sovereign wealth funds globally managing geopolitical risk? Because that seems like a very big thing now, is geopolitical risk. Everyone keeps talking about geopolitical risk. Does that play a role in sovereign wealth funds' activities?
It does. We've seen a lot of different approaches in terms of geopolitics. If you think about Western sovereign investors, including Canadian pension funds, European sovereigns and pensions, and Australian superannuations, they're all focusing more on developed markets and in the US, just because of the restrictions that they have with their respective stakeholders to invest in places like China or Russia. Now, if you think about the Middle East and Southeast Asia, I always say that they are very blessed in the sense that they can operate in both markets, right? So Middle Eastern funds and Southeast Asian funds are still very bullish in the US. Vehicles like CFIUS are happy to take Middle Eastern money, which is quite surprising because historically CFIUS has been more focused on Chinese capital coming into the US. So Middle Eastern capital has actually been very welcome in the US historically. And the same goes for Southeast Asian capital, right? So funds from Singapore, they are very welcome in the US. And at the same time, they can also invest in China and Russia without upsetting Western markets, it seems. So I think they have a privileged position in the sense that they can hedge their bets and invest in both markets equally. And I think they are the ones that are going to benefit more from this sort of geopolitical distress if they play their cards correctly.
What's interesting is that last year in one of the episodes we interviewed the head of research at Khazanah in Malaysia, and it was interesting talking to him, looking at how Malaysia is balanced, because Malaysia is in quite a unique place in the sense that it's a very close ally of the US, but also at the same time it's very close to China, and a lot of Chinese companies use Malaysia as a conduit for putting its AI and semiconductor operations. Do you think countries like Malaysia and others are having a tough time in terms of balancing this, whether they have to choose a US-aligned order or if they have to choose a more, say, Chinese-led order?
Yeah, I mean, Kazan is a good example where they were focusing, when it comes to the US, in venture capital first. And they actually had an office in San Francisco for a few years. And last year, they decided to switch that office to the East Coast, to New York, just to focus on later stage private equity. So I think they are consolidating their positions in the US. In Europe, they used to have an office in London. They closed it down as well. So obviously conscious of cost. But I think they've done very well in the past year or two. their returns were actually among the highest in the sovereign wealth fund space last year. And I think they are now going for a stronger position once things at home have been stabilized. And I'm talking about Malaysian Airlines, for instance, that is in the portfolio of Kasana, and as you know, went through significant distress in the past. So I think Kasana is in a very good position to benefit in the next few years, also from that point of view of balancing both Western and Eastern investments.
Diego, on the last episode, we interviewed somebody who talked about the BRICS and this drive towards the global south and de-dollarization and all these kind of topics. It seems now that there's been a little bit of a slowdown in terms of BRICS, in terms of their coordination and the push. I know I was reading an article yesterday saying, I think an Indian minister was basically saying that they're not pushing too much for de-dollarization. With a weakening US dollar, obviously from Donald Trump's policies and this kind of pushback against US-led order, how will sovereign wealth funds, do you think, are mitigating any risk? Like, they don't want to obviously miss out on the US opportunities, because obviously the US is the biggest equity market, but still at the same time they want opportunities in other markets. It's kind of similar to the other question I asked you, but like on a more broader macro scale, do you think like this drive is playing a role in their activities?
Yeah, I mean, historically, sovereigns, I mean, as you know, there are very different types of sovereign funds, but the ones focusing on savings, which are normally more liquid, they are highly exposed to US dollars, right? And historically, if they were investing in places like Latin America or Africa, they were always looking for USD denominated investments. So that was the preferred way to go. Now I think that they are realizing, some of them, that are heavily exposed to USD in case anything were to happen. So we've seen actually some of them hedging their positions and buying more gold, or even diversifying more the currency baskets that they hold. So it's definitely having an effect in having them to think about what would happen if the US were going to distress, or we're gonna go down in terms of the US dollar. So it's definitely having an effect, but still, as I said before, they're trying to diversify and keep a balanced portfolio in general.
Yeah, that's interesting. And then if we look, Diego, at the Gulf, last time in our last episode, we talked a lot about the Gulf. And obviously, you guys have published a lot of research on the Gulf sovereign wealth funds. It seems to me that, there's still, again, a big player in the economies over there, and indeed on the global economy. And I'm always reading articles, for example, Mubadala is investing a lot in the UK. You're hearing about PIF wants to get involved in different things. How would you characterize Gulf sovereign wealth funds so far this year?
Yeah, I mean, we just published our first half of the year report, right? And Gulf sovereign wealth funds were very active. They deploy about 36 billion US dollars, which is about 36% of the global transaction value in deals around the world. Obviously, people always talk about Gulf sovereign wealth funds, but the reality is that each of the Gulf sovereign wealth funds is different and are in a different part of their journey, right? So, for instance, there are now 3 sovereign wealth funds in the Gulf that are over $1 trillion in assets, which is incredible, right? So ADIA, according to our estimates anyway, because they don't publish reports, PIF and also Kuwait Investment Authority are over 1 trillion in assets. Now, all 3 are in different journeys, right? So if you take ADIA, for instance, ADIA is 50 plus years old. So it's a very mature investor, very sophisticated investor. They keep investing in the US, but also trying to diversify away from it. And they actually just opened an office in India, and they're trying to invest more and more in Asian markets. But also they're selling more and more assets. So they are monetizing some of their portfolio because they know how to identify by now where the opportunities lie, and trying to invest in new themes that are going to be important in the next few decades, not years, but decades. So ADIA is I think, ahead of anybody else in the Gulf in terms of thinking ahead. But also, as you said, I mean, if we stay in Abu Dhabi, Mubadala is amazing what they are doing, right? So they are everywhere, everything all at once. Is really incredible what Mubadala is achieving, not only with the corporate headquarters, but also the number of subsidiaries that they now have. Obviously, they have the Abu Dhabi Investment Council, ADIC, which is a very different kind of investor now reporting into their books. Also, NGX, which is focused on AI. Mubadala Capital, which is raising third-party capital. M42, which is a joint venture with G42 for healthcare. So it's really amazing what Mubadala is achieving everywhere, investing both domestically and overseas. Again, staying in Abu Dhabi, ADQ, I think is obviously newer, and they're still trying to find, what their thing is. But in reality, they have become really important players in the Abu Dhabi ecosystem as well. Most of their subsidiaries like Etihad, Modon, Ataxa, they are all key to the Abu Dhabi ecosystem. And they are also investing a lot in emerging markets, including Turkey, Egypt, and also Vietnam. So even outside of the Gulf. And then I mentioned Kuwait Investment Authority before. I think this is one to watch in the next few years. I mean, they changed their CEO recently. The new CEO, Sheikh Saud Sabah, he's from the royal family. He's only 35 years old, which is really incredible. And they are now monetizing very mature assets like Bank of America or AI. They had these stakes for 15 years, and they're deploying that capital into AI, which is really a huge change for a market like Kuwait. So I think this is one that we are keeping a close eye on. Then PIF, as I said before, they just passed 1 trillion in assets, but they are in a very different journey, right? So you cannot really compare them to Adia or to KIA being around much. They were around almost at the same time, but their sort of change in mandate only happened in 2016, 17. So they are still considered like a startup in the world of sovereigns. A huge startup is still finding their mandate. About 80% of their portfolio sits in the kingdom, and that has been revisited, as you know, because of some delays and some sort of issues that they are facing. But the remaining 20% is still very significant. So $200 billion that they invest overseas. So they are also moving the needle overseas, and they actually closed the first investment in a Manhattan real estate office, which is something that they hadn't done before. And they just open offices in both Beijing and Paris. So again, touching on every continent from Saudi. And then just to finish, Qatar, I think it's also enjoying a new leadership. They changed the CEO a few months ago as well. And they're now focusing more on the domestic markets. They have a very ambitious venture capital program, and they are attracting venture capital funds into Doha and investing in them. And then lastly, Money Investment Authority has been doing an incredible job in helping descale the huge debt that the Sultanate had in the past. So I think Oman is doing very well, and we expect good things coming from OIA also in the next few years.
Yeah, it's interesting. Like you said, each Gulf country is different, and each sovereign wealth entity has their own idiosyncratic story. What I find interesting is Kuwait, like you mentioned, right? Kuwait is probably I think KIA is the oldest sovereign wealth fund in the world. It just seems like I think even last time when we spoke, I think politics in Kuwait is very fascinating, and that it's changed a lot in the past, say, 5 years, and now with like you said, a new leadership leading the sovereign wealth fund in Kuwait over there. How much, if Kuwait gets its act together, let's say, from my perspective, how much of an impact do you think Kuwait could have on the sovereign wealth fund landscape globally?
Oh, it's huge, right? I mean, we talked about the $1 trillion that they have. I mean, it's not only KIA in Kuwait. As you know, the Kuwait Investment Office, which sits in London, was open even before the one in Kuwait. So they have a very sizable, over 200 people sitting in London investing in all asset classes. And they got a subsidiary called Wren House Investment that has been investing in infrastructure all around the world. And they just opened an office in New York. So I think if they become more active from the point of view of the headquarters, that could move the needle a lot. I mean, they have a lot of dry powder and sort of they can punch over their weight for sure. And it's not only KIA, actually. I mean, if you look at PIFs, which is the pension fund in Kuwait, traditionally has also been affected by the changes in power at government level. So if that gets stabilized and they are managed to put into work the 150 billion plus that they have in pension capital, that will also move the needle when it comes to private equity, real estate, infrastructure globally. So that's why we are keeping a close eye into the developments in Kuwait. I was just in Kuwait a few months ago. I hadn't been in 10 years, and it's changing rapidly, I would say.
And Diego, obviously we're in a world where with all this volatility in financial markets, but of course oil prices are a big thing for the Gulf sovereign wealth funds. How much is a lower oil price environment playing into their calculus?
It does play a big role. And we were talking about low 70s before. That price is actually below I think the break-even price for 3 of the countries in the GCC. So Bahrain has a very high break-even price. I think it's the one that is going under with this kind of oil prices. So that's why I didn't even mention it, because they've been the most quiet, I think, of all, Mumtalakat and FGR. But then Oman is getting better, so the break-even price is getting lower. And Qatar and UAE are always going to make money because the break-even price is very low. It's in the 30s or 40s. But Saudi is the one that is going to struggle a lot, right? Because of the volume and the scale of the projects that they have embarked on. And I think right now the price is below what the IMF is expecting for the next few years. So hopefully either they will manage to get the oil price up, or they will have to start fundraising capital from third party if they want to complete all those projects that they have in the kingdom right now.
I mean, Diego, one of the things I think that's fascinating, hasn't really been talked about too much, is the level of debt that's being accumulated by Saudi Arabia at a sovereign level. If you look at the debt levels compared to where they were even 3 years ago, let alone 5 or 10 years ago, they've just spiked a lot. And what I can see is that a lot of this borrowing has been done by the PIF and PIF-related entities. I mean, with, a high interest rate, a low oil environment, how much of a risk is that to PIF, do you think?
So if you look at the numbers, I think it's less than 50 billion that PIF has raised in bonds, and that means less than 5% of the balance sheet. So I wouldn't say it's worrying yet, and I think there is still room for PIF to raise more capital, either via debt or via equity, by opening new vehicles like Mubadala Capital is doing for Mubadala. PIF has certainly room to raise some equity. Debt, I think, is still not worrying. 5% is still a very manageable debt, and actually it's a level of debt where we're seeing across funds in North America, like CalPERS is now at 5%. The Canadian pension funds are way above that. So I wouldn't say it's necessarily worrying yet at PIF level.
And one other thing, Diego, just sticking on PIF and some of the others, is that there's been this big encouragement over the past year or so, is to encourage PIF-related companies to do their own borrowing without the implicit guarantee of PIF or the main entity. And with the struggles in IPOs, because there's been a bit of a struggle, obviously we've had a bit of a boom in the IPO market in the region over the past couple of years, but now there seems to be a bit of a slowdown. How much of that will play a role in, say, some of the listings of some of these PIF-related entities?
Yeah, Tadawul continues to be the largest stock market in the GCC, and I think the market is much more diversified. I mean, if you look at the ADX in Abu Dhabi or even the Qatar Stock Exchange, their reliance over sovereign wealth funds is much larger than in Tadawul. So in Tadawul, you have a lot of companies that get listed and are participated by either local family offices or even international players. So I think that Tadawul will need to keep growing, but I think at the moment is sort of the largest market by far in the GCC. And the companies will feel, right? So, I mean, PIF will have to continue floating companies in Tadawul, not Aramco, but other companies that can provide that diversification of the capital base. And again, that's something that we are seeing across the GCC, right? So last year, we did an analysis on GCC bourses, and the reliance is about 70%. So 70% of all the market cap in the GCC is actually owned by sovereign entities. It's a huge number. I mean, if you think about it, in the US or European terms, that will never happen. But I think the state capitalism is very important in the GCC, but they need to push for that diversification of the capital base in the years to come to ensure sustainability and also resilience to global crises.
Diego, one thing that's interesting is that I had the opportunity to go to an event organized by IPIM in May, talking about private markets globally, but also with where the GCC is playing an important role. If you look at Gulf sovereign wealth funds, a lot of them, like as you alluded to, they play a big role in things like private credit, but at the same time, they're also investing in things like public equities, and indeed they're going into more further afields. Like I was reading an article about how some of these sovereign wealth funds are even looking at countries like Syria, which is in the reconstruction. What kind of sectors are these Gulf sovereign wealth funds looking at in 2025?
Yeah, I mean, the Syrian case is quite incredible, and it's DP World, right? So DP World has been investing in both emerging and developed markets everywhere, and it's quite striking that they can invest in a place like Syria today. But I think in general, and again, just bearing in mind that every sovereign is on a different stage of their growth. I think they're looking for more partnerships, right? And I think we talked about last time we spoke, but it's not the case anymore that GPs are going to the Middle East with a bag, and trying to fill it with money and leave the whatever emirate or country in the same day. I think now sovereigns are looking for a more long-term commitment into the region, and for more long-term partnerships where both parties can benefit. So I think GPs must now be ready to commit either in capital or in time or efforts if they want to build a stronger relationship with the sovereign funds in the region. So they are definitely focused on partnership. I think if you look at some of the asset classes that are newer to them, like private credit, I think they are relying on partnerships just because it's their way to learn more about that particular asset class. So in the future, they will probably become more direct investors, but at the moment, they use the investment managers to get to know that particular asset class, to build internal capabilities, and then being able to tackle that asset class on their own in the future. So it's quite interesting, again, the different journeys that sovereigns are going through in the Middle East.
Absolutely. And the other thing that was interesting is if you look at ADQ, they played a big role in Egypt. I think last year they provided a big credit line to Egypt. Definitely there's this idea of, I don't want to call it checkbook diplomacy, but there's definitely a lot of political capital as well being invested via these sovereign wealth funds, right?
Indeed, yeah. I mean, that investment in Egypt, or commitment, I should say, because it hasn't been materialized yet. $35 billion out of a $250 billion fund. It's a very significant commitment, and I think it definitely gets them a lot of soft power, if you will, in a very important and neighboring country with a critical mass when it comes to demography that the UAE may not have. So I think there is definitely that play of sovereign wealth funds in the Middle East that is quite unique to the Middle East if you think about it. I mean, I don't see, GIC and Temasek investing in Vietnam for soft power. I think it's very unique to the Gulf countries where they look for that sort of soft power in Turkey, in Egypt, in Jordan, in Syria, which doesn't happen in other parts of the world. So again, very fascinating from the point of view of geopolitics and keeping an eye on the intersect between politics and finance.
Very true. If we look in the Middle East, but away from the Gulf, do you see any opportunities for other sovereign wealth funds? Because, I was reading about, Turkey's got its own sovereign wealth fund. Iraq was talking about creating its own sovereign wealth fund. Egypt as well. Do you see any other countries in the region that are non-Gulf countries that could play a role in the sovereign wealth fund landscape?
Yeah, I mean, one we spoke with last week, and we're going to feature an interview with them, is actually the Israeli sovereign wealth fund. So it's called CIF, the Citizens of Israel Fund. And they've been growing. They have now $2 billion in capital, but they could grow up to $72 billion if the forecast of their oil gas holds true. So that could be an upcoming player, I would say, in the Middle East outside of the Gulf. I mean, the others that you mentioned before, obviously Egypt, from Egypt to Morocco, I mean, all of them have sizable sovereigns. Libya is one that we are also speaking a lot with, are having they're pursuing best practices, and they are trying or getting ready for their assets to be unfrozen and to being able to invest again and to move their 68 billion plus portfolio that they have around the world. So that's something that we definitely need to be aware of. And then on the other side, as you said, Jordan, Iraq, they have proposals for smaller funds, but I think that's a longer game for now.
How do sovereign wealth funds that are backed by resources as opposed to resource poor countries, was there a difference in the way these funds operate, or is it pretty much the same?
So generally, I would say that those funds that are sourced out of oil, just because they are wealth abundant, they normally play a stabilization or savings mission. Those funds, on the other hand, those funds that do not necessarily come from oil, and I put you an example in the Gulf, ADQ, even though it's sitting in Abu Dhabi, was not sourced out of oil revenues. It was sourced as an umbrella company of all the major national champions in Abu Dhabi. So those funds will have a more strategic mission, if you will, where they will need to create wealth as opposed to manage wealth. So I think that's the key difference on how funds differ. Now, one fund can become another one. So if we use the example of Mubadala again was sourced with stakes in companies, but with time, they have become a more savings fund just because they have matured more as an investor, just like we've seen here with Temasek. So funds can change their mission over time, but I would say in general that those funded with oil will pursue a savings mechanism, whereas the others will pursue a more strategic one.
Very interesting. One thing that's been interesting, I think, is that in the days of 2021, 2022, 2023, in the run up to COP in Dubai and in Egypt before that, this idea of sovereign wealth funds pushing for ESG. Do you still see sovereign wealth funds are serious about ESG, or do you think there's a rebalancing in their portfolios and mandates?
Yeah, I think there is a rebalance or a general review of what ESG means for funds, right? And we've seen, as you said, even the push that happens right after COVID on ESG front. I think a lot of the funds started joining UNPRI, joining the One Planet Sovereign Wealth Fund, committing to net zero goals. And I think it was just the thing to do. But in reality, they were just, checking boxes. And I think at the moment there is a review of what ESG means for the portfolio. And again, it may mean different things, right? So if you look at the key metrics that sovereign wealth funds report on the ESG front, if you look at PIF, one of the key metrics for them is creating employment. And that is a valid ESG metric, right? It's creating employment. It's a social measure. Whereas for ADIA, it may be investing in green energy, in green infrastructure around the world. So because funds are so different and their portfolios are so different, their metrics and their understanding of ESG is very different from one to another. So I think we are going to keep seeing them focusing on different ESG matters. It's just that they are going to be, I think, more selective and more aligned to their portfolio rather than just ticking general boxes because they have to.
Yeah, what's interesting is that I think some of these funds, they had their own mandates, right? And they kind of follow the more incumbent large players like BlackRock, and other financial institutions which are no longer part of initiatives like the Net Banking Zero Alliance, and some of these other UN initiated programs. So where do you think Gulf sovereign wealth funds are going to be investing their money in the second half of 2025 and going into 2026?
Yeah, I mean, to your point before, even we've seen it in the area of sovereign investors, right? So this year, actually, a few months ago, CPP Investments, which, as you know, is the largest investor in Canada, they decided to remove their commitment to net zero. And they say it's because it was creating unnecessary pressure into their portfolio. And we've actually found a positive correlation between sustainability and long-term performance. But I think, again, funds need to revisit what ESG means to them. Going back to your question, what we're going to see in the next 6 months, it will not necessarily be about sustainable investing. I think there is a huge component about AI that we're going to keep seeing. And AI has the danger of being just another FOMO thing, right? So fear of missing out. And I think it's important for funds to recognize that venture capital was overheated and then died. Crypto was sort of overheated and then died. So they have to recognize where are we in the AI revolution and where do they need to invest, right? Because some of the funds like Ontario Teachers in Canada or Temasek here in Singapore invested heavily in FTX and lost a lot of money in crypto, right? So I think some of them are being more cautious and they need to be more cautious when investing in AI. And I think that's why they're pursuing more partnerships rather than direct investing. So that's something that we hope or we expect to see more and more in the next half of the year.
Conversely, Diego, one thing that's interesting, obviously we saw the stablecoin bill passed in the US, and the UAE is working on its own CBDC, and along I think Bahrain as well has just launched a stablecoin framework. Do you think sovereign wealth funds in the Gulf particularly, they're getting more excited about cryptocurrency and digital or these other like financial digital technologies?
I think they will still look at blockchain and the technology behind it. But I think, again, because of the past failures of other funds, they will be extra careful in investing in a particular exchange or coin for that matter. So there is excitement. There is always reviews of potential investments. But I think the due diligence will have to be very tight in order to ensure that they invest in the right asset.
Before we bring the podcast to a close, Diego, there's just two questions I wanted to ask you. They're a bit different from each other. First is we talked in the last episode about transparency, and you mentioned as well just now earlier on is about they don't release figures or they don't release data. Has transparency improved with sovereign wealth funds analysis, or do you think it's still an issue? There's about transparency, disclosure, quality of data. How do you think that can play out?
We're seeing two strains or two approaches when it comes to transparency. Actually, we talked about it in our most recent report because we saw a few funds in the Middle East becoming more opaque, actually. They stopped publishing certain things that they used to. And I think it's as a result of the geopolitical tensions. So we tested the thesis that sovereign investors were investing more domestically, and therefore they were becoming more opaque because they didn't need to be as transparent. And it actually holds true. So about 40% of the deals that happened during the first half of 2025 happened within their respective economies. And that was kind of, a great finding for us. But then on the other hand, we have a few funds that, because they are starting to raise capital, they need to be more transparent, right? So there is no chance of them staying opaque. And I can mention names. I mean, PIF started this process 4 years ago. When they started raising bonds, they needed to publicize their financial statements. And now it's one of the most transparent funds, not only in the Middle East, but globally. And the same goes for ADQ, right? So ADQ started publishing prospectus in the London Stock Exchange just because they started issuing bonds. So now we all know how much they own and what sort of portfolio they have. So I think some of the funds that need to be will be more transparent, but some others that not necessarily need to be transparent may choose to stay opaque for the foreseeable future.
And how does that play with like other more larger, well-established ones like Norway? Because obviously Norway is, the benchmark that a lot of these funds aspire to. Not necessarily the Gulf funds, but do you think that plays a role across the board, or do you think the Gulf particularly is hard to source data from?
I mean, not necessarily. If you think about it, even here in Singapore, right? So you have Temasek and GIC. Temasek is very transparent. Financial statements are out there. We all know how much return they had last year. GIC, on the other hand, nobody has a clue on what they own. Even their employees have to sign a very strict NDA in order not to disclose that information to anybody. So even within the same countries, you can see the two approaches. And the reason is, again, Temasek is issuing bonds and it's in their DNA to be more transparent and sustainable. And GIC doesn't invest in Singapore. They only invest overseas. They don't have any third-party capital, and therefore they don't need to be transparent. And the government of Singapore has said over and over again that it's against their interest to disclose how much they own in the balance sheet overall, just to defend their currency. So again, it doesn't have to be conflicted. It's just that it serves the purposes of that particular fund.
With 1st of August being a deadline for many tariffs that Donald Trump is going to be allegedly or expectedly announcing more tariffs on countries. I was a bit surprised when he announced tariffs even on countries like Bahrain and others. Do you think the second half of this year, many people that I've spoken to, portfolio managers, people, financial practitioners, are anticipating more financial volatility coming. How do you think Gulf, or rather global sovereign wealth funds, are going to manage this fallout if there is more volatility?
Yeah, I mean, look, I'm Spanish American, right? So I know that our president enjoys this kind of volatility and this kind of mixed messages. But in reality, some of it is just noise, right? So you have to differentiate what is noise and what is real. I think Middle Eastern sovereigns, again, are benefiting from this particular situation where they can invest in both the US and in the East as well. And they are hedging their bets. They know that they cannot be as heavily invested in the US as they were before. And funds like ADIA, that is 54% weighted in the US, they know they have to diversify. And that's why they are opening offices in the East. They are organizing high-level delegation trips to China and Vietnam. So I think we're going to keep seeing that diversification efforts coming from the Middle East. But again, they'll keep investing in the US just because the volume of the deals happening there is always larger. But yeah, I would try to differentiate what is noise to what is real in terms of the economy, and then how is that going to affect the financial markets, right? Because again, financial markets that don't seem to be stopping anytime. So we've been worried about these tariffs since the start of the year, and in reality, global markets are still 8% up since January. So yeah, I think Middle Eastern funds are well poised to still benefit from any volatility that is happening in the market if they play the cards correctly.
Even if you say this, but even like, for example, when Israel attacked Iran in June, that led to a lot of panic in the markets. And, although it didn't escalate further after the American strike, if this happens again or a similar situation happens again within the Gulf, let's say, because obviously there's been wars throughout the Middle East through a long period of time, and that hasn't really impacted. How does Gulf geopolitical risk play a role in the Gulf sovereign wealth funds calculus?
Yeah, I mean, I'm not saying the Gulf is bulletproof, right? So obviously now we have employees there, and I travel often there, and I know that the sentiment is different than it was a few months ago, and that the pace has slowed down in the past couple of months. But still, you see a lot of global deals happening. Luckily, all these funds now have offices overseas that still need to put that capital to work. So I don't think they're gonna stop deploying capital, but it's true that they are keeping a close eyes, just like anybody would if a war is happening in your neighbor's house, right?
Very true. Tell us any projects you're working on or any upcoming projects you're working on.
Yeah, I mean, as I said, we are consolidating our position in Asia and the Middle East. And now that we've rolled in our AI tool, we're very happy and sort of spreading the word through our clients. I think the future is going to be like how to manage that growth. So we've been growing very rapidly in the past 5 years. So now it's about finding the platform and the processes to ensure that that growth is sustainable in the future. So very excited with what is ahead. I'll definitely keep an eye on the Gulf and Asia as the key regions.
And what's the best way to read your research if you do publish any research that's not behind the paywall?
Yeah, we do publish some research that is not necessarily behind the paywall. Is on globalswf.com. So actually our latest GSR scoreboard is publicly available, and it includes a market update on the first 6 months of the year. So that is a good example of and showcase of what we do for our clients if anybody wants to reach out.
I'll link it in the show notes. Yeah, it was a really fantastic, your research last year when I was writing one of my articles in Abu Dhabi. It's becoming a magnet for global asset and hedge funds. But and you're still active on social media, right? On LinkedIn.
Yeah, we're very active on LinkedIn. We now have, I think, 22,000 followers, which is incredible.
Amazing. And you yourself are reachable on LinkedIn, right?
Yes, yeah. Absolutely.
Okay, amazing. I'll link it in the show notes. But Diego Lopez, this has been a fantastic part 2. I'm really hoping we can get a part 3 done maybe in 6 months' time. But yeah, I really thank you once again for coming on the podcast and telling us more about sovereign wealth funds. And yeah, thanks again.
Absolutely. Thank you very much, Hassan, and all the best for your upcoming 68.
Thank you so much. Thank you.